I'm Tom Selzer from Livewire, and joining me today is Ben Preston from Orbis to discuss what is an interesting time for global equities and how they're positioning right now. Ben, thanks for joining us.
Thanks for having me.
Ben, it's inarguably been a great year for global equities, but are you seeing any warning signs under the surface right now?
Yeah, it's been a strong year, as you say. The only thing is that it's been driven in large part by a handful of companies, mega cap US tech stocks that have gone from sort of quite expensive to even more expensive. And when markets get very concentrated like that, it can be a little risky because investors are all trying to get into the same thing. They tend to outbid each other to try and get those stocks into their portfolio. That can cause overvaluations. And then you can get, as that unwinds, you can get market losses. So definitely things for investors to look out for.
And do you think that market concentration is potentially opening up opportunities for investors that are willing to look elsewhere in the market?
Definitely. It's like the tide. You know, if it's high in one place, it has to be low tide somewhere else. As all the investor money gets channeled into an increasingly small number of shares, it can leave undervaluations elsewhere. So there can be a lot of opportunity for investors that are brave enough to look elsewhere to find bargains that are just not on investors' radar screens.
And how is that being reflected in your global equities fund at the moment? Do you have an example of, say, stocks that you're looking at that fit that criteria?
Yeah, we've got a whole portfolio full of them, I suppose. What you could say is that the world looks a little skewed at the moment. So something like the US, which is only one country, of course, it's 4% of the world's population, it's 25% of the world's GDP, but it's 70% of the world's market cap. That's very skewed. And so if you want to get real diversification into your portfolio, it may be necessary to look beyond the US. And if you do that, you'll find that there's some really good values. And so, I mean, we can talk about investments that we have in Korea or the UK or Brazil, Japan. Sector-wise, we can talk about healthcare, defense, maybe even some chemicals names. So definitely quite different from what's been grabbing all the headlines, which is the big mega cap tech.
Do you maybe have any specific examples?
If, for example, you want to get AI exposure, but don't, shy away a little bit from paying 30 times earnings for NVIDIA, which is in all the headlines, there are ways to get exposure to AI without having to pay that price and expose yourself to that downside risk. So if you go to Korea, you can find companies like SK Hynix, which is the leader in high bandwidth memory. It's right at the center of AI, because you need high bandwidth memory to sit on an NVIDIA chip alongside their logic chips. But instead of paying 30 times earnings, if you buy SK Hynix, you're paying more like 9 times earnings. Earnings are going very well. They're sold out already for next year with all their memory. But it gets even better because if you buy SK Hynix through SK Square, which is a holding company, then that's priced at a 60% discount. So you're really effectively paying 4 times earnings for SK Hynix. The reason is because these legacy concerns about Korean corporate governance, which is actually improving. Either SK Hynix does really well or you get a slight narrowing of this discount.
And so how else are you positioned in the fund right now?
Well, it's not all about technology and AI. So something like healthcare, which is at the other end of the spectrum, if you like. A lot of investors have been throwing money to try and participate in technology and AI. But something like healthcare, actually money's been coming out of the sector. Trump has been pouring cold water on it, as we know. So there's a bit of a down cycle in that sector. When you have that down cycle, that's when investors can get quite pessimistic, and that produces low share prices, and then we can take advantage of that. There are some really good healthcare companies out there. That's true of the health insurers, equipment providers, testing companies, and the drugs companies themselves. Things like Genmab, Alnylam, doing really interesting things with new drugs. But again, investors don't tend to pay them that much attention because they're complicated and they take a little bit of a while to understand.
Maybe moving on to how investors can position themselves right now. For investors that are concerned about current valuations, what advice do you have for them?
Well, I would think that it's a good time to be a little concerned about valuations. There are usually ways to buy companies and protect a little bit about the downside if you're disciplined about the price that you pay. And so there are thousands of companies out there that you can buy on the stock markets. If you're really careful about picking shares with the downside protection you need, the way to do that is to look and to imagine a whole range of future scenarios, not just whatever you think is the most likely thing to happen. And then look at how a company will behave across all of those future scenarios. And sometimes you come across these companies where even if things are pretty bad, you don't lose that much, but if things go well, then you can make a lot. And so that's the advice I'd give for investors looking at how to invest in equities and protect against the downside risk. Do your homework and be prepared to be bold and to do something that's a bit different from what others are doing. It can seem risky, it can actually be less risky.
And finally, for investors that are also potentially worried about not having enough diversification in their portfolio, how do you think they should be going about getting that diversification? What should they be looking for?
Well, it can be quite tempting to think, look, I've got 5 or 10 funds in my portfolio, and therefore I'm well diversified. What really matters is what's in each of those funds. And I think it can be the case that if you go through and actually look at the holdings, you find that they often end up holding the same types of companies or the same actual companies. And so as an investor, you're much less diversified than you thought you were. So that can be an issue to watch out for. The way to do that, to make sure that you're appropriately diversified, I suppose, is to make sure you've got a range of different funds or managers or shares that will do well in different environments. And that in that way, whatever the future might hold, you've got something that will do well in that environment, and that puts you in a much better position to get good risk-adjusted returns.
Ben, thanks for joining us.
Thank you.
Thanks for tuning in. For more great videos, make sure to check out our YouTube channel.